Right. So warm greetings to you, colleagues. My name is Mr. Privilege, a tutor with Grad Consulting for FAC 3764. I'll be facilitating you guys throughout the entire period of this academic year to guide you guys with respect to the content that you need to know in as far as this module of accounting is concerned. So this is our first lecture for the 2024 academic period. And what we'll be looking at would be pertaining to the conceptual framework for financial reporting. So now let's get into it without any further ado. So obviously this is the first learning unit or the first topic that you need to, to know with respect to the module. So what are the assumed knowledge, or what we normally call learning objectives, as it were, with regards to this concept? Firstly, you need to be in a position where, after you've gone through this discussion, be able to discuss the objective of general purpose financial reporting and the qualitative characteristics of useful financial information, which I'll take you through shortly. You should also be in a position where you are able to identify reporting entity and its reporting boundaries. Apply the definitions of an asset, a liability, equity, income, and expenses in a given scenario. Very important, especially in bullet point number 3. Most of the typical questions you would get pertaining to this concept, they will be testing you with regards to the applicability of definitions on the asset element, the liability element, equity, income, and even expense element. What are these elements that I'm referring to? These are what we normally call elements of the financial statements, right? So it's made up of assets, liability, equity, incomes, and expenses. Now, within the umbrella of equity, there's drawings as well. So it will be dealt within that, proximity of equity elements. Then, of course, number 4, you should be able to apply the criteria for including assets and liabilities in financial statements. What is the recognition criteria before you can recognize something as an asset that ought to be classified as one? Same thing with the liability. How do you recognize liabilities when you are presenting them in the statement of financial position? And similarly, there are instances where, for instance, maybe an asset is no longer useful to the organization. Think of it in the context of a PPE asset, such as a motor vehicle. Let's say we've fully depreciated the vehicle, or we have sold the vehicle, disposed the vehicle. So when we do such, it means we have to de-recognize the asset from our books. So what are the procedures that ought to be followed when you're de-recognizing an asset in the books of a reporting entity? Similarly, it's the same story with the liability. Remember, with liabilities, from a broad perspective, this is debt that we are owing to third party. So after fully settling the debt, or after we've exhausted the repayments of the debt, how do we get to de-recognize a liability from our books? So there are standardized procedures on the principle, based of course on the principles of the IFRS standard, that we need to follow when we are de-recognizing a liability out of our books as a reporting entity, right? Very, very, very important. You'll get questions with regards to bullet point number 4 as well. So you need to really give special attention to that, right? Then on the next page, you must also be in a position where you can explain the measurement basis and their applicability in given scenarios, all right? So when you're talking about the measurement basis here, we're saying, how do you, determine the value of an asset, for example, depending on the category? Because remember, with assets, there are 2 classes. We've got non-current assets, and then we also have got what we call current assets, right? So when we are recognizing, or when we want to measure the value of these assets, they're not measured the same way. So there are different models that are used in measuring assets. For instance, we've got what we call the historical costing model, right? And then we also have got what we call the carrying value model, or carrying amount model, which is almost similar to the fair value model anyways. And then, of course, it's the same thing that, of course, you would deal with when you're looking at inventory, which is to say inventory should be recognized at the lower of value, lower of cost or the net realizable value. So it's the fair value model or principle of measurement that is being applied in such instances. Why am I speaking like this? Because some of these things that I'm explaining to you, you were introduced to these in FAC 2601, which is the second year financial accounting module, right? Then, of course, proceeding with the assumed knowledge, you must be in a position to explain concepts and guidance on presentation and disclosure. Communicate clearly and concisely in a professional manner appropriate to the audience and situation. Now, this bullet point all the way up to the last bullet point, they much have to do with what you do when you are now participating on my UNISA platform, especially with respect to the discussion forum where the lecturers will be present and also other students. So those are the other audiences. So you have and you ought to communicate in a professional manner. Very important to take note of that, right? Now, without any further ado, what we are discussing today, it's based upon chapter number 2 of your prescribed textbook. So the one that I've used in capture or compiling the notes that you are seeing on your screen right now, it's based upon Gripping Gap 2022 version. Now, there's a Gripping Gap 2024 version, which is the most recent or latest version of your textbook, as it were. So, but in any case, the principles are really much the same, right? Especially as far as this particular topic is concerned. Now, with other topics, you notice that I will then be using the most recent textbook for that endeavor. Now, let's begin to start with the first thing of discussion for tonight's engagement. So now, part of your assumed knowledge was stating that you need to know the general purpose of the conceptual framework. So where you see me abbreviating CF, I'm simply referring to conceptual framework, all right? Now, what is the general purpose of the conceptual framework? Because that is what we are discussing in any case in this topic. It's about the conceptual framework for financial reporting. So why do we as business entities or reporting entities ought to follow the concept or the principles of the conceptual framework in accounting? Well, number one, the conceptual framework is essential in as far as the development of the international financial reporting standards are concerned. So it is very useful in particular to the IASB, which is the International Accounting Standards Board. So they actually base the development of the standards on the basis of the conceptual framework, right? Now, the conceptual framework, you'll notice that it's a standardized framework for the profession of accounting that is applicable at a worldwide scale. So it's not just something to say we're only confined to follow this practice in South Africa alone, for instance. But the conceptual framework is also followed even in the United States of America, even in Australia, or any other place you can think of, right? Now, another essential reason why the conceptual framework is important is because it helps those who prepare financial statements to create their own accounting policies when necessary. So when they're creating their accounting policies, it has to be confined to the conceptual framework principles. It also helps everyone, including in this case, the ISB, even the the preparer of the financial statements and the users also in this case, to understand as well as to be able to interpret the IFRS standards. That's what the conceptual framework seeks to achieve. So that is one of the key reasons why there is such a thing called conceptual framework in accounting. Now, on the next page, we continue to explain the purpose of the conceptual framework, which is to also provide financial information about the reporting entity. So it helps to ensure that the information necessary with regards to how the organization has performed, in financial sense, can be made available to the user. So it helps to provide Sorry, no. This is a different thing. Sorry about that. So the conceptual framework, these are the three important reasons why they are there. But on the next page, I'm explaining about the general purpose financial reporting. I think I just need to wear my glasses. Right. So with the general purpose financial reporting now, it's a different thing. It's still, embedded within the conceptual framework. It's part of it. But in any case, let me try to explain to you what financial reporting entails. And when you're talking of financial reporting, what should come into your mind? We are looking at an umbrella of reports that have to do with the financial activities that have transpired within the organization. So within the financial report, before I even explain why it is necessary to have one as a reporting entity, okay, it also incorporates within it what we call the annual financial statements. It also incorporates within it what we call the audit report, the audit committee report, any other related financial, reports. Reports on and the financial activities that have transpired within the organization. You would find them in the financial report. So think of it as an integrated report of an organization, right? So number one, why is it necessary for reporting entities to have one? Because it provides financial information about the reporting entity, RE. Financial information that is useful to who? To the existing as well as potential investors and lenders and other creditors to the organization. Why is it that it provides such information? So that they can be able to make essential decisions regarding to the entity. I repeat again, financial reports, they are essential as they provide financial information about the reporting entity, all right, that is useful to existing and potential investors, lenders, and creditors. So creditors or lenders here, these are people that we owe money, or people that, organizations and even people that we owe money, or institutions that we owe money. Think of it if we had obtained a loan from the bank in this case. So the banks or financial institutions would fall really within the umbrella of lenders here. So they can lend us money, debt to finance our operations, right? So that's debt equity, right? Or they can basically give us a loan, perhaps to acquire a certain asset or certain group of assets in our organization, right? But so this financial information that is created is useful to these participants, or should I say users of such information, so that they can be able to make decisions relating to providing resources to the entity, right? So if you notice, existing and potential investors, together with the lenders and other creditors, all of these people, or rather all of this group of individuals, they are providing something. They're providing resources to the organization. It could be in the capacity of equity that is coming in, or it could be in the capacity of a debt that is being offered to the organization, right? What are the limitations of general purpose financial reporting? So there are limitations, obviously, that a financial report may have. One of them is that it only provides financial information, and it's not designed for all the users, okay? And it's not designed for all decisions. Not exact information could be provided in the financial report, and it only gives you information concerning what has happened historically. So it's not designed to show the entity's actual value per se, right? So those are some of the limitations. What kind of questions would you get if you go to, I believe it will be test one, because remember with this module, you'll be having year tests, you'll also be having some assignments that you'll be doing. So in those assignments, they can ask it as an MCQ-based question to say, identify a combination of limitations of the general purpose financial reporting. So you must be in a position where you remember this. Okay, general purpose financial statements. General purpose financial statements is part of what we call financial reports, right? So it differs obviously from a financial report. Financial statements on the other, so okay, look at it this way. With financial report, here's what happened. They encompass a variety of financial information. So there are other records that are within a financial report. So this also includes things like some journals and all that. It's part of your financial report. But then also financial statements becomes, or it is actually part of a financial report for a reporting entity. Now, question is, what information do we get when we look at annual financial statements? So it conveys details about the economic resources, which meets up with the definition of an asset. Okay, I'm not this one. Oh, because I'm using a slide, it might not. All right, let's see. So it conveys information about those economic resources which meet up with the definition of an asset. All right, and it also conveys information about claims that meet up with the definition of a liability or an equity. And lastly, it also conveys information about, those changes in resources or changes in claims which meet up with the definition of an income or expense. By just looking at these things that I'm highlighting, automatically in your mind, you're already being given what I would call hints about what the prospective or potential definitions of these things would really be. For instance, if you're looking at income, income is basically change in economic resources, but from an increase positive side of it. All right. And then obviously the expenses, it's change in the claims. All right. So if the claims increase, meaning if say liabilities increase, that also implies expenses are increasing. All right. Very, very important to take note of that. Economic resources, obviously, those, that is just simply to tell you that, assets, these are economic resources of an organization, right? Very, very important. So when we are looking at financial statements, we are able to see or to identify these elements in the different sets of financial statements that an organization could actually have. So obviously, we have got what we call, in fact, there are four sets of financial statements that one ought to know for the purpose of this module. So there's what we call a statement of financial position. Statement of financial position, it reflects on, in fact, let me show it to you on the whiteboard, excuse me, so that these things can make a bit of sense. I know you might be familiar with this because obviously some of these things, you were introduced to them at a second year level module. But just as a recap, it's important that we outline it right. So I would just call this set of annual financial statements abbreviated. So what are the set of financial statements that a reporting entity should have? So number one, a reporting entity should have what we call a statement of financial position. Now, it is within the statement of financial position where we see a true reflection about the change in economic resources that we're talking about in the slide, which in this case would be not the change in economic resources, but the reflection of the economic resources that the organization has, and those are assets. And then, of course, change in claims which the organization have, or the claims rather that the organization has, not the change, the actual claims themselves, which is in this case, the liabilities. All right, let me put it this way in plural so that at least it would make more sense. So we see assets, we see liabilities in the statement of financial position, and we also see equity items in this statement. Then the second financial statement is called the statement of what? Profit or loss and other comprehensive income and other comprehensive income. Now, in the statement of profit or loss and other comprehensive income, that's where we see the change in economic resources, which is incomes. Then, of course, we also see the change in claims against the organization, which can be reflected as expenses. So notice what is happening there. These, obviously, are part and parcel of the elements to the financial statement. So when we look at the actual financial statement, what information are we seeing there? What information are we observing being conveyed therein? So those are what we call elements of the financial statements, right? Then, of course, just for completion's sake, you've got then what we call a statement of changes in equity, statement of changes in equity. Right, so obviously most of the things you see there, it's equity items and drawings. Then lastly, then we've got something called the statement of cash flows, right? With the statement of cash flows, two things that you can see. You are seeing cashed incomes and cashed expenses. That's all that you're seeing there. Or let me just say cashed incomes, or should I put them as receipts in this case, other than to call them cashed income. So we are simply seeing receipts, meaning to say actual money received. And then you are also seeing cash expense, which I would say actual expenditures here. Actual expenditures paid, right? Because the money would have already gone out. Then, of course, as part of the financial statement, there's also what we call notes to the financial statements, right? So this one, it's not a financial statement, but it's just that, I mean, it accompanies the financial statements themselves. So when you're talking of reporting on a company's, I mean, if we are talking of financial statements being reported by a reporting entity, we are talking of this. I know it might be something that is familiar, but I just wanted to make sure that I refresh your memory. Are you familiar with this?
Yes.
Beautiful, beautiful. Is it making sense?
Yeah, so far.
Wonderful. Let's continue. Now coming back, so that's what I was just trying to explain on this page, all right? When I was talking about what the financial statements conveys. So yeah, I've already explained it. Now let's talk about the general purpose financial statements. What is the primary objective of financial statements? So essentially, financial statements are there to provide the user with the useful information about a reporting entity's elements, which is assets, liabilities, equity, income, and expenses, right? So the structure of financial statements, I've already explained it typically from the whiteboard, which was what you had here earlier on, just so that at least, yeah. So it's the same information that I've conveyed in that slideshow that I was showing you. It's this very same information, right? So now let's go back to the slide. So it's just the same thing here. But now let's go on to the next slideshow. Now I want us to talk about questions you can get as typical MCQs, as typical MCQ based questions. What are those typical questions you can expect? They can ask you about a combination of qualitative characteristics. So there are two types of, or two groups of qualitative characteristics. You've got what we call fundamental qualitative characteristics, and then you've got what we call enhancing qualitative characteristics. So these are the two groups. Then within each one of them, there is, sub characteristics, if I would say. So with fundamental qualitative characteristics, there are two that are very important that you need to know. So there's the relevancy characteristic and the faithful presentation characteristic. So we need to understand, what does it mean if we are saying, the financial statements have got, this characteristic of relevancy, characteristic of faithful presentation. What exactly does it mean? So if you look, of course, on the presentation I've given you on the group, it has, below it has got some footnotes somewhere, right? It has got some footnotes, but I think because of the way I'm displaying my presentation on the screen, you might not be able to clearly see the footnotes that I've put, because the footnotes there, which I've embedded, I'm explaining what the relevancy characteristic is all about, what the faithful presentation, principle or characteristic in this case is all about. So now let me start with the relevancy characteristic, which is part of fundamental qualitative characteristics. What does it mean? So with relevancy, it simply means the information is relevant. So if information is considered to be relevant, it can mean one of the two things. It means that it is capable of making a difference to the user in as far as the decision-making is concerned. Now, for information to also make sense or make a difference in the decision-making by the user, it means we need to have a predictive value, and we also need to have a confirmatory value, right? In other words, it means that the information that has been provided or conveyed in the annual financial statements by the reporting entity, it can be verified. I mean, it can be confirmed. Values that are there, they can actually be confirmed, all right? And they can also be estimated. That's the predictive value aspect. So they can also be estimated, right? Very, very important. So relevancy or relevant information, it means it enables the user to make an informed decision, but on the basis that there are figures that are provided therein. What about faithful presentation? Presentation simply means three things. It means that the information conveyed in the financial statements is complete. It is neutral. In other words, there has been no influence whatsoever to jeopardize the integrity of the presented information. It also implies that the information conveyed is free from error. So the person that probably was responsible to prepare the financial statements, prepared the information, was competent to prepare the information presented, right? What are the steps that we follow in applying fundamental characteristics? How do we apply fundamental qualitative characteristics? You can get a question about this in an assignment. So step one, we identify an economic phenomenon. That is basically to say we identify an event that is transpired. The event is what can result in an existence of an asset. An event, it can be anything that can result in the existence of a liability, equity, income, or even an expense. So you discover with majority of the definitions of these elements of the financial statements, there's always an issue about as a result of a past event, as a result of a past event. Wow, okay. Right. So step one, when you're applying this fundamental qualitative characteristic, you identify the economic phenomenon that has the potential to be useful to the user. So is there any event that seems to reflect anything to do with assets in the financial statements? Is there an event somewhat that seems to reflect the existence of liabilities, equity, incomes, and expenses by the entity? Because obviously the users, they're interested in those things, those elements of the annual financial statements. Why? Because they'll be useful to them in their decision making. Step number two, you must be able to identify what type of information would be most relevant. Now that you've identified the economic phenomenon, but out of all of that, what is the information which is most relevant? Meaning to say information that would make a difference in the decision making by the user. Then lastly, determine whether the information is available and can be faithfully presented. It has to be available. What does this mean? If maybe the user wants to verify, for example, your assets, are they able to trace back to the supporting information in form of financial statements? That's what it means. Are they able to trace back to the information that has been conveyed in the financial statement? So there has to be something that supports this information for it to be considered faithfully presented. And of course, not only with the notes to the financial statements, remember, we also have other supporting documentation. Yes. Yes? You wanted to say something?
No.
Hello?
No, I didn't want to say anything. I'm just listening.
Oh, okay. I thought you wanted to say something.
No.
All right, great. So those are the steps about fundamental characteristics. Now let's go to enhancing qualitative characteristics. So with enhancing qualitative characteristics, these are like complementary characteristics to the ones that are fundamental in nature. Hence, you see, for instance, that with enhancing qualitative characteristics, they are essentially there to enhance or to elaborate, to give emphasis on the fundamental characteristics. And this would also involve ensuring, of course, that the information presented in the financial information, not only that it's relevant, not only that it's been faithfully presented, but with enhancing qualitative characteristics, they help to ensure that the information is comparable, the information can be verifiable. I mean, it is verifiable, understandable, and it has been prepared on a timely basis. Very important. So now, what does these things really mean? If we say information is comparable, it means it has comparability elements to it. So comparability of information implies that it allows the users to identify similarities as well as the differences among items, right? Think about it this way. When you generate your financial statements for 2024 academic year, 2024 rather, in general, and you already had prepared financial statements for 2023 financial period. When you compare the information, you'll be able to pick up similarities. True or false?
True.
That is if nothing has changed, all right, in as far as operations of the reporting entity is concerned. But if there are certain things that would have changed, you'll be able to pick up some differences. That is why there's something they call variance analysis and ratio analysis. It is there for that purpose. Is it making sense?
Yes.
Then, of course, if we say information is verifiable, it has to have that verifiability attribute. So verifiability simply means that the information can help us to assure the users that the information has been independently assessed by knowledgeable observers and found to be faithfully represented. So the verifiability of information means it can be audited. Can it be audited? In other words, can we have somebody independent of the organization who can be able to give an opinion to the presented information as to whether indeed it has been faithfully presented according to the IFRS standards? Understandability means that the information should be clear and concise to the user. Timeliness of information implies that the information should be made available on a time, like timelessly, so that the users are able to use it in their decision making. So that's why, for instance, at the end of every financial period, all right, there is, I think, a certain period that is given for organization to create or to generate their annual financial statements, which is normally 6 months after the reporting period. The audited financial statements should be ready for issue. Does it make sense?
Yes.
Hello?
Yes, I'm here.
So what I'm telling you,
Can
this
you
is
hear
what
me?
happens in practice. At the end of every financial year, there has to be a 6-month period by which entities are given to produce financial statements, especially with public companies. Those are the scenarios that they normally encounter. Are we together?
Yes, we are.
Beautiful. On the next slide, I'll begin to talk to you about the elements of financial statements of note. So there are 5 essential elements of financial statements in the context of this module. So namely assets, namely an asset, liability, equity, income, and expenses. So now what we're going to do on video B, I'll begin to unveil the details regarding to these 5 elements of the financial statements. So far, so good.